All right, what do you say, Alp? Should we get going here?
I am ready.
Excellent. So thanks everybody for joining us. Want to roll through this, get everybody some great information here in under an hour. So thanks again for being with us today. I am Jason Dahl. I'm a certified financial planner and the director of financial planning services at AFS Financial Group. With me today, remotely still, is my colleague Alp Adebeck. Alp is the founder and managing partner of AFS. And a quick mention, I know we've got several folks tuning in today from what we affectionately call the 401k side. So just as a quick reminder, so Alp and I and Natalie, who works so hard in making these presentations awesome, we all work for AFS Financial Group. So we operate as a separate entity from the AFS 401k Retirement Services team, but we certainly collaborate on a lot of items, especially when it comes to the financial wellness programs and these workshops and presentations. Lastly, before we launch into this, I want to encourage questions. So please, at any time during today's session, please feel free to type in a question using the Q&A box. There should be a Q&A box on your toolbar. It's just kind of like a chat function. We'll keep an eye out for those as we go through today's presentation, and we will address those as we go. And we kind of reserve the right to where, hey, if we know we're going to cover something related to a question, we might hold off on it, but please don't be shy. Fire away questions at any time, whether it's related to what we happen to be talking about at that moment, or if you just something popped in your mind. But I will say probably our favorite question is, can I schedule a time to meet with you, Jason and Alp? And I'll say absolutely. If there's anything that you would like to go over, whether it be related to today's discussion or anything in your personal financial planning, investment management life, or just otherwise, maybe you just want to chat. Let us know. We'd be happy to schedule a Zoom call or just a regular old-fashioned phone call. We truly do love what we do, and I'll say probably the best part of what we do is connecting with people, right, and helping you solve your personal financial planning puzzles. So please don't hesitate to reach out. All right, so the obligatory disclaimer slide here. I also just want to add, for if anybody, because we will be recording this, we will be sharing it as a recording. So if you are listening to this in the recording form, just remember that this is dated information, right? Most of all the data and the slides and things that we're going over are as of September 30th, 2021. There are a handful of slides that are actually as of the end of August, but just making sure we could sort of put that out there on the disclaimer. All right, so let's kind of get into the good stuff. So we're going to start off with kind of an overview of some of the key moments going back to the beginning of 2020 through now, basically, right? And what were some of the items thus far that have really shaped sort of where we are now in the markets and in the economy? I think it's probably safe to say that a lot has happened since January 2020. And now I'm not going to read everything on these slides. Rather, I'm just going to kind of highlight a few of the items that are more kind of market specific, or at least the ones that we think that have kind of most directly impacted the markets and sort of where we are today, and hopefully that will kind of set the stage well for today's presentation. So to begin with, if we go all the way back, what seems like a really long time ago, to January 2020, right? So that year started strong in the markets, right? It was kind of finished strong in 19 and moved into another strong start to the year, with basically every major index trending higher in January 2020. Then, of course, we all know what befell us, the world in the late January, February, March timeframe of 2020. So it's just sort of highlighting March 23rd, right? So if we think back, right, you always have the benefit of hindsight when recognizing, okay, when was the bottom, right? So remember, we had the big market sell-off in February to March timeframe, and it was March 23rd that ended up being the bottom. And so that sell-off was actually the fastest reversal from a bull market, right? Because we had been in a bull market, to then a bear market. So the fastest reversal from a bull market to a bear market in history in that February to March timeframe. Then if you look there at April 14th, in less than 1 month later, we had the fastest bear market to bull market reversal in history. So what is it? I guess the fastest reversal of the reversal in history, all within that kind of two month time period. But so now let's look at sort of the latter half of 2020 and into early 2021. So a couple big moments, right, on a lot of fronts. But in that November 16 to 18 period, you see that Moderna and Pfizer announced that their COVID-19 vaccines had an efficacy of 95%. And not surprisingly, the markets rallied off of the positive vaccine news. Look at November 24th. You'll see kind of a notable moment in the markets. The Dow Jones Industrial Average hit the 30,000 mark for the first time in history. Look at mid-January now into 2021. You'll see that we hit record highs in the Dow, the S&P 500, and the NASDAQ. And we're going to talk a little bit more about this with some of the slides, the international investments and the value investments all kind of joined the game, because really sort of up until that point, it had been primarily sort of a U.S., not just U.S., but a U.S. growth sort of driven rally in the markets. So then we go into the second half of 2021. Well, actually, before we get to the second half, I want to highlight March 13th, third round of the stimulus checks. Third round of stimulus checks went out in March of 2021. I think it was over 170 million checks went out. May 14th, you'll see the Fed announced the third extension of the Paycheck Protection Program, right, to help support small businesses. We kind of highlight those two because those items have contributed to sort of the liquidity in the market, right? And all of that, and businesses' ability to stay open, to pay people, right? And just checks going directly into people's hands or deposited into their bank accounts, allowing folks to continue to consume and buy stuff. And those have been important contributing factors to where we find ourselves in the market. And then lastly, you look there, August 24th, the S&P 500 marked its 51st record high of 2021 alone. Right, so that matched the most in any calendar year. The NASDAQ also hit 15,000 for the first time, marking its 30th record high of the year. All right, so you kind of get the theme, hopefully, that it's been a kind of a remarkably strong market in general, especially here in the U.S., despite, right, a global pandemic that we've been in. And so this is one of Alpin, my favorite quotes. I think probably my favorite Warren Buffett quote. Be fearful when others are greedy, and be greedy when others are fearful. So what does that mean, right? So we're going to kind of talk about this on a number of different slides, but sort of a little bit of that contrarian view, right? A little bit of that. Don't always just go with the flow, right? You know, sometimes it's important to take a step back and look at things and see, gosh, if all the headlines and everybody's talking about things going one direction, right? Whether it be all sunshine and rainbows or all doom and gloom, right? It's important to sort of take that step back and recognize, oh, could this be an opportunity to maybe trim a little bit, right? If things are feeling just too rosy, maybe I want to trim, take a little bit off the table. Or if things are feeling too gloomy, maybe this is an opportunity to buy, right, and find some deals, find some bargains out there. And we're going to talk about that in some of the slides as well that will illustrate.
So Jason, I want to test your Buffett history a little bit.
Let's do it.
So what was Buffett doing during the pandemic? So Berkshire Hathaway, obviously, his company, sitting on boatloads of cash.
Right. So was he being greedy? Was he licking his chops, right? If because people were freaking out for good reasons, right? For a lot of different reasons. Interestingly enough, during that period, that kind of February, March market sell-off, where the market was down 34%-ish, I think it was the S&P hit its bottom. So remember, I said it was the fastest reversal from a bear market to a bull market ever, and I think that kind of contributed to the answer here, Alp, that Buffett actually didn't deploy a lot of cash, didn't go on a buying spree during that period, which I think we were a little bit surprised by, right? Given his track record and his history, and especially if you go back to the financial crisis, where that's when he really scooped up a lot of deals during that period of time. But no, and I think in large part, it just because it happened so fast.
And valuations were expensive, I think, when it happened. But yeah, it was an interesting period where a time when I'd say Buffett missed an opportunity. And maybe, as Jason said, it was just that it wasn't enough blood in the streets and the fact that it happened so quickly. But it was really fascinating
Mhm.
that he did not pick up, the bargains.
Yep, yep. So Al, you want to lead us through kind of where we stand in the markets and the economy?
Perfect. And for those who've seen us on the webinars, you actually see a different background for me. Our offices are actually in the midst of being renovated right now. So I was actually still going into the office and always broadcasting from there. But right now I am actually sitting in my daughter Natalie's old bedroom, as I've actually taken it over as my office. And so this is her view of downtown Bethesda behind me, or I guess it's Wilson Lane. We're really close to downtown Bethesda. All right, so what we have on the screen here, not meant to scare you, S&P 500 index at inflection points. And so that inflection point title, not meant to say, okay, we're going to start heading down, but this is a 25-year history of what's gone on with the index. On the left side of the screen, you can see March 24th of 2000. That's actually when the tech bubble was peaking. And you can see the forward price to earnings ratio of the market was 25.2. And so the higher a PE is, the more expensive a stock, or in this case, an index is. The lower it is, the cheaper it is. And you calculate a price to earnings ratio pretty simply. If a stock is $100 a share, and they earn $5 a share in profit, you divide 5 into 100, and that gives you a PE of 20. So if you look at in the middle of the page, March 9th of 2009, you could see the forward PE at the bottom of the market after the credit crisis, after literally just burned the village down, was 10.4. And our friend Warren Buffett was buying up everything. And he took out an op-ed in New York Times telling people to buy equities because he was. And you just see that we've had this incredible run up. And today, September 30th, or at the end of last quarter, we were at a forward price to earnings ratio of 20.3. So market is definitely getting more expensive. Not catching up to the, I'll call it the tech bubble period yet, but it is clearly getting more expensive. Jason, you're muted. You asked me something? I'm sorry. Jason, I
Thank
can't.
you. Yes.
Sorry about that.
Clicking around here. You think I've done this before? No, I was. There was a question here I was curious about. This seems like kind of a steady trend, right? Relatively consistent on this path. But then something changed over this past year in that trend line. What do you kind of read into that?
So I think a great question. If you look at all the periods, you could actually see that like a trend line during a buying period and in a sell-off basically gets maintained. And so we've had this incredible run up, and then we had basically a sell-off with the pandemic and a recovery. But what is different this time is the trend line has now gone a little bit higher. I use the term that it's gone vertical. And I typically don't like seeing that market action. I believe in long-term trend lines that, you'll see something like it might break above it a little bit or break below it a little bit, but kind of stay within a trend line. And so when you see a breakout, I generally look at that as like a frothier period in the market. So, something that we're mindful of. Makes it more difficult to buy after that type of breakout. So the next slide gives you a really good history of that gives you the 25-year history of the forward price to earnings ratio. In the middle, you can see the 25-year average of the forward PE is 16.78. And if you look at it today, we're basically considered one standard deviation above that average. But the grizzled vets of the market, when they see this 20.31, one of the things they point out is we're in a different period compared to March of 2000. Because if you remember your money market and I'll call it CD history from that time period, you could actually get money market returns, CD returns, treasury bill returns, bond market returns that were 5, 6, 6.5% back then. Today with money markets and CDs, we're pretty close to zero. You can get some online money markets might pay 0.5%. So I think we've seen highs maybe 0.6, but really low numbers. And so you'll see people say that, you know what, the price to earnings ratio should be substantially higher in 2021 compared to the year 2000. So we're actually not that worried about the PE ratios right now, even though we're one standard deviation above it. Things that we do focus on is when you do a little bit of breakdown inside the S&P 500, the top 10 stocks on the left side of the screen here, the PE ratio of the top 10 stocks is actually substantially higher than the rest of the market. So the top 10 stocks PE is 28.6. And on the bottom of the slide, you can see their names, you know, the normal cast of characters these days. Apple, Microsoft, Amazon, Google. Google gets listed twice because they have two different share classes. Tesla, Berkshire Hathaway, which is Buffett's company, Nvidia, big chip company, JP Morgan, Johnson & Johnson, but it's mostly being driven by Apple, Microsoft, Amazon, Facebook, and Google, and Tesla, the main tech companies. Their price to earnings ratios have exploded to the upside. And so the rest of the market's PE is 19.1. So 10 stocks traded an average 28.6, the remaining 490, 19.1. The weight of the top 10 stocks, this is a fascinating slide. So the weight of the top 10 stocks in the index, they actually make up 29% of the index. So that means the remaining 490 stocks in the S&P 500, the 500 largest publicly traded companies in the US, the remaining 490 only represent 71% of the index. But what's also interesting, and it's earnings week this week, I think we have Apple reporting tonight, Amazon, and I think one other big company. We've already had Microsoft, and who else posted? Facebook posted and Google posted. But the earnings of those top 10 companies is at a historic high, basically sitting at 28.2%. So really fascinating that while these companies have gone up and are selling at high multiples, they have really been growing very, very fast.
I'm going to take this opportunity to pose one of the questions we got here, Al. There's obviously been a lot of talk about supply chain disruption. So why hasn't that impacted the markets more?
Yeah, I get in this debate a lot. I think one of the things that the market has always done is try to differentiate between something that is long-term in nature and something that's short-term. And is this something that's really going to change the direction? And I think on the supply chain, I think the market has concluded that we will get this resolved. And so they'll adjust down maybe a specific industry or a company that has really been impacted by the supply chain. They'll adjust it down a little bit, but for the most part, they will give them a free pass. A great example is the auto industry because they've been greatly affected by the supply chain. If you go by any new car dealership's lot, there's virtually no cars there, and at times almost zero cars. And the market says, you know what, we actually think the demand's there. The demand will be there if it takes a year to get this run, to figure it out, or to run through the supply chain. They think that there'll be plenty of demand in a year's time, so they're actually not discounting the auto companies at all right now.
I suppose too, Alp, I think we've talked too about how, companies like Microsoft and Facebook and Google, a supply chain is a very different thing than it used to be.
Yeah, they are affected some, but probably one of the most fascinating things, I'll use the example of Microsoft, where if you think about, if you were using technology in the 90s, when you were upgrading some software, you were putting in that 5.25 floppy into your disk drive, then you went to a 3.5, and then you went to a CD-ROM, right? Today, for them to produce another unit of software, since it's basically almost all delivered online, there's zero cost to them. So think about some of these technology companies today, Google, when they are doing searches, right? There's really no cost. They have their infrastructure cost of building, data warehouses and obviously paying their engineers, but it's fascinating. So much of a different world for technology today compared to 20 years ago. So those companies have become more valuable.
Yeah.
Great slide here. So this basically is a history, 20-year history of the forward price to earnings ratio of the market. So I'm going to go to the right side of the screen, the current PE versus the 20-year average. And if you look at the large cap growth on the top right, these are the Microsofts and the Amazons of the world. The current PE is 28.6. The 20-year average is 18.5. So you could see on the growth side, on that top right, everything is selling at pretty big premiums. And if you go to the bottom, it actually puts it in perspective of percentages. Large cap growth is basically selling at a 54% premium compared to the 20-year average. What's interesting is on the value side of the equation, it's actually fairly reasonably priced. Value being the blue chip dividend paying companies, much more stable, but I'll say generally the non-tech oriented companies that do have cost of goods sold, they are actually fairly reasonably priced. And one thing that's really fascinating, like they show here, the small cap values basically selling at the 20-year average. And that's after, since the market low, I'm now going to take you to the middle of the page. Since the market lows in March 2020, small cap value has been the #1 performer. It's up 131%. So despite being up that amount, it's actually still selling at a discount to its 20-year average. So it was really, really cheap. Things that are fascinating on this side here, since the market low, pretty much everything has rebounded very nicely. From the market peak, this is kind of a little bit on the, oh, well, things definitely are expensive. So if you go back to February 2020, pre-pandemic, large cap growth, which was already on an incredible run and had performed, I'll say, amazing for the last 5 or 6 years. From that point, it's still up 44%. And again, that's where we get a little bit of reservations. Again, and acknowledge that these are profitable companies printing money faster than the federal government, it seems. But
so can it continue?
Joke. Yeah, you know, always a great question.
Is it harder to, you know, do you commit new dollars there?
I do think that. I know we've had those discussions in our investment committee meetings. It's easier to commit new dollars to some of the dividend-oriented ones, but this trend is amazing. Like I would say I'd prefer to buy on a pullback, a deeper correction. And most people forget because the market's been so good in the fourth quarter of 2018, large cap growth took a bath in a very short period of time. It was down about 35%. So that's why we have reservations at times after these kind of big spikes, like, it's just tough to add new money there. So to me, this is actually one of the more fascinating slides. Like Jason, when he was going over what's happened over the last 2 years, he talked about when they announced like the efficacy dates of the virus. And so what we have here, it's probably one of the best examples of, for once, I'll call it fundamentals actually mattered, but they break it down between, I'll call it pre-vaccine announcements and post-vaccine announcements. So in gray, that represents the performance of these various sectors during that period, December 31st to November 6th of 2020. And the green is from November 9th through the end of the third quarter. And so if you think about pre-vaccine, the sectors that just got annihilated, I mean, crushed, like energy, airlines, retail REITs, hotels, resorts, and cruise lines. Banks, because they thought they would be stuck with a lot of bad debt. Office REITs, because everyone's questioning, are you actually going to be able to fill up the office buildings again? Surprised on the residential REIT side, I think people thought there was going to be, or I guess they weren't aware that there'd be a lot more of a federal backstop there, because that came back very strong. But post vaccine announcement, just take a look at the reversal. Right? It's amazing. Everybody's like, all right, we're going to get through this. Airlines came back to life. And I actually thought that the airlines were probably a couple quarters away if the vaccine didn't get announced until, let's say, mid 2021. I think the airlines probably would have all had to have pretty much defaulted and gone into bankruptcy. They wouldn't have gone away, but I think existing shareholders would have been wiped out at that point. But really just a fascinating example of what has happened. And what's interesting is on the bottom, online retail did tremendous before the vaccine. afterwards, it hasn't done as well. So really a pretty cool slide, and just shows you the power of the vaccines and what that meant to not just the US economy, but the global economy.
Maybe obvious to everybody, but I always like to clarify acronyms: REIT, Real Estate Investment Trust. So just, investments in retail real estate, office real estate, residential real estate. Yep.
Thanks, Jason. So Jason, this is your favorite slide, so I'm going to pass it off to you.
Sure. Yeah. Thanks. I do love this slide. It's simple but fascinating in my view. Let's see if anybody else agrees. So what we're looking at here, this is going back to 1980, and the gray bar charts represent where the S&P 500 finished each year. Okay. So annualized. So in 1980, the S&P 500 finished the year positive 26%. Okay, you can see where it finished every year since then, all the way through year to date, or third quarter 2021, was up 15%. You'll notice, right, most of these are positive or above the line there. In fact, 31 of these 41 years are positive over this time period. However, what I think is probably the most fascinating piece is just the simple overlay with these red dots. And what each red dot represents is the largest intra-year decline. Okay, so despite finishing the year up 26% in 1980, at one point, the S&P declined 17%. So you look at that, oh, wow, 31 of 41 years were positive, but the average decline, the average of the red dots, is actually over 14%. So pretty significant, right? Typically, folks use the term a correction, like an official correction, when it's more than a 10% decline, right? So on average, we've had at least one official correction annually. And so, but then if we hone in to year to date, the largest decline year to date is, I'm going to put in quotes, only 5%. Right, so relatively calm, modest kind of year. And then if you go back, right, if you think about, if we go all the way back to March 23rd, 2020, this is still the largest decline, right? And so that is also just kind of note, right? On the one hand, that sort of macro view to take a look and remind yourselves, like, it's normal for there to be declines, for there to be corrections, sell-offs, however you want to describe it, right? And I think most folks on this call, that, right? But it's important for all of us to kind of remind ourselves, but also just recognizing that, what, we may be getting due for something a little bit larger than just the 5% that we've seen. And this one, this 5% is actually just in like the last month and a half. Prior to that,
It's recovered since then, but
it's recovered since then, right?
It had dropped because it was literally 4% prior to that for 16 months, 17 months.
Yeah. So now, kind of again, sort of macro view. On the left-hand side, we've got sort of GDP, so real GDP growth, and you kind of see the trend line there with the blue dot, right? Just sort of tracking the actual sort of gray line. Hopefully this is obvious to everyone, right? What caused this in the pandemic, sharp recovery, right? A lot of that driven with the vaccine, a lot of that driven by, stimulus, the paycheck protection programs, all the checks that were sent out to folks has contributed to this. Most folks feel that, barring some unforeseen surprises, that we should get back to that trend line here pretty soon, probably before year end. But I actually find the right hand of this slide the most interesting. Is just kind of a breakdown. Okay, so what are the components of GDP, right? And again, so GDP is basically, right, the most common sort of measure of our economic output as a country. And the biggest driver, almost 70%, is consumption. It's you and I buying stuff, right? Paying for services, buying goods. I think I just heard yesterday that they're anticipating sort of the retail season here going into the holidays to be one of the best ever, with a huge increase over last year.
If they can get it.
If we can get there. Yeah. If we can get it on the shelves, get it delivered. Yep.
Interestingly enough, this morning, GDP came out for the third quarter. So this is hot off the press. Underperformed. Third quarter GDP was only 2%. People were expecting it to be 3+%. So despite the stimulus payments, and this shows you the supply chain disruption though also, but it's just the economy is can't grow that fast these days.
Yeah, yeah. And I do think this is also kind of an important reminder of sort of what's the logic behind sort of the stimulus, if you will, right? Getting money in the hands of folks, especially in a crisis. Well, because a lot of that money goes right back into the economy, right? And it helps kind of prop a lot more up than just the individual household who received the check. So this is, Alp and I really enjoy kind of looking at this. We've been looking at this chart for several years and sort of as it's evolved, not as far back as 1900 ourselves, but this is just kind of I guess technically you call it a logarithmic chart of the S&P 500 going back to 1900, overlaid with some, very important, notable kind of historical events. And the thing that we kind of like to point out is sort of this recurring theme a little bit, where you see periods of, like, despite sort of ebbs and flows, you look at it over a period of time and it kind of was flat. And then we had to have a breakout with the Roaring 20s. Obviously, the Great Depression was a huge market sell-off, sharp recovery there, and then went through a period of time where, you had World War II. Obviously, the market struggled there, but came back and kind of went flat over a 10-plus year period. Then a breakout, right? The post-war boom. And then another kind of flat period, and the stagflation years, and oil shock and so forth. And then we had another long breakout in the 80s and 90s, right? Culminated with the tech boom, right? In the late 90s, in the year 2000. Then we had, a flat period. It was actually the first full 10-year period in history that the S&P 500 did not have a positive return. So that was kind of of note. And then we've been on this breakout again. And so sort of the simple question that kind of Alp and I sort of ponder and wonder is, could this breakout last similarly kind of as long as these last two did, right? The classic disclaimer, right? History is no guarantee of future performance, but it is kind of interesting to sort of see those trend lines and how things have sort of tracked going all the way back to 1900.
And no question, completely driven by tech boom. We joke and think someday we'll see this printed. Maybe it'll say tech boom too.
Yeah, somewhere along this line.
Because it's been amazing.
Yeah.
So now a little bit of the cold water. So this is the 2022 federal budget, and total spending expected to be $5.5 trillion. And what's bad is, we're going to actually have to borrow 1.15 trillion to make ends meet. And so this is actually a brand new slide for this quarter. The August 31st slide showed the prior fiscal year. The government operates on an October 1st through September 30th fiscal year. And so the cold water was even worse for the last slide. The deficit for last fiscal year was over $3 trillion. And if you look at the bottom of the page, basically we are on the right side, you can see the federal net debt as a percentage of GDP pretty much pushing historic highs. And if you go to the left side, you can see during World War II that, we spiked up and then came right back down. The government, the economy grew, right? So really good shape quickly. And then for a while now, we've been like 2005-6 time frame on, we've actually been racking up a lot of debts. And what's disturbing, despite this spike up, we are still projected to grow the deficit, right? So, wow, expensive, right? Can we handle this?
So this is the government. So how's the consumer?
So, that leads perfectly to the next slide. I would actually say that when you take a look at the consumer, this is, and Jason earlier talked about the consumer makes up 2/3 of GDP spending. The consumer is in fabulous shape. Years ago, one of the money managers from PIMCO made a comment that when you go through these periods like a credit crisis, and this is before the pandemic, he pointed out that ultimately you end up seeing the debt shift over to the federal government. Really fascinating. And so in this situation, you got consumer balance sheets at 159 trillion from the March 2007 peak before the credit crisis. It was 85 trillion. So it's grown tremendously. But what really is, I'll call it, the driving of this economy is the household debt service ratio on the top right. Debt payments as a percent of disposable personal income. During the credit crisis, everybody refinanced their homes because obviously mortgage rates got cut and people kept refinancing, and people reined in their spending a little bit because the credit crisis was such a tough period for people to digest in America. But what is fascinating is that it actually stayed low, and forever people were expecting this to spike up, and it never did. And then you throw in the pandemic, where people stopped spending money and they were getting stimulus checks. And a lot of this data shows that people receiving stimulus checks were actually saving more than people had expected. But then you also got another round of refinancing, right? So it's just placed the consumer in a really good position. And I would say that one big difference compared to prior periods when people have refinanced, everybody these days has generally gone to a fixed rate mortgage. So they've got like a 15-year loan or a 30-year loan. Where back in 2004, 5, and 6, everybody was doing they'll call it the 1, 2, 3, 5-year, even 7-year adjustable rate mortgages. Those, while they still exist, you don't see anybody actually go towards them. So again, consumer is just in fabulous shape right now.
If any of you've had a call with Alp or me in the last several years, you've probably heard Alp's famous line of the gift that keeps on giving.
The low mortgage rates.
The low mortgage rates.
So are you taking this one, Jason, or am I taking it?
Go for it.
I'm going to take it. So are we going to skip ahead? I think go back one.
Whoops.
Just talk about jobs openings.
Oh, here we go. Yep.
So we've got job openings basically through the roof these days. And a lot of people know that some of that is because we offered such enhanced unemployment benefits. Some people did not want to go back towards, I'll call it the hospitality industry, but across, I guess, all sectors, lots of job openings right now. 11 million strong. So we tend to think that bodes well for the economy. The economy has a lot of room to grow because there's just a lot of slack there. I realize growth is still on the weak side, but again, a very positive situation having this many job openings right now.
And I know this gets a lot of headlines, kind of and one contributing factor certainly is what Al mentioned, right? The unemployment benefits, right? That helped a lot of folks to kind of have that flexibility, and that has contributed to folks not racing, some folks not racing back into the job market. But I think that, as we've seen, there's a number of other important variables that are playing into it, not least of which is, we are still in the midst of a pandemic, right? We have not kind of reached the vaccine rates, the thresholds, right, that were kind of originally hoped for or targeted to. And, imagine if your previous job maybe was a minimum wage job and you didn't have great benefits. Maybe you're caring for a child who hasn't been able to be vaccinated, or maybe you care for an elderly person, right? There's just a lot of variables that are playing into, and what we're seeing in the data of sort of what's contributing to folks not kind of getting back into the job market, and some of this is, and we're going to talk about this more, is contributing to, and in our view, hopefully will result in some wage growth for the sort of lower end of the economy.
So what we focus on a lot is what's going to happen with inflation. And it's probably I'll call it the $64 billion question, or maybe even say the $64 trillion question. Is inflation transitory, as Jay Powell and Janet Yellen are mentioning in all of their conference calls? Or is it more permanent in nature? And I get in a lot of debates. I think what the central bank is looking at is just this 40-year history that inflation just hasn't been sustainable for a long period of time. So if you look from 1981 on, it's peaked for very short periods, and then it's come right back down. Again, a fascinating chart. And you look at that trend line. I mean, I just tend to think that inflation is low for longer. And I know there's a woman by the name of Kathy Wood who runs the ARC funds, and she's been commenting lately that she actually still thinks deflation is a risk. So it's fascinating. A lot of people on both sides of this debate. I think our office tends to think that it is transitory. We'll see it as soon as the supply chain gets caught up with. You'll probably see prices come back down. But it's something that is just a super hot debate right now, because the tools to, I'll say, combat inflation is they try to slow down the economy with monetary policy, which means they try to raise interest rates.
I think it's kind of fascinating. You look at this, I really don't know sort of what it means going forward, but there's a whole generation, multiple generations now that have no idea what inflation is, right? Right? You just go back to, it wasn't since the 70s, really.
But no doubt on a temporary basis, you go into the grocery store, it's expensive. And if you're selling houses now, prices have gone up, right? I think some of that's more a reflection of low interest rates.
Yeah.
So
speaking of,
yeah, this is Ray Dalio, who runs the world's largest hedge fund, Bridgewater Associates, and he points out it just all comes down to interest rates. And what he means by that is the lower rates are, it just makes it easier to do everything. Like if you get a low rate car loan, you can buy a bigger car. You get a low rate mortgage, you can buy a more expensive house. And so that basically dictates just the value of those items. And it's the same thing from when you're buying a business, where if my alternatives to getting a dividend or stock appreciation by buying a company is really low interest rates out of a money market or a CD, but there's a company I can buy that will actually give me a strong dividend or has a history of just growing real rapidly but doesn't pay a dividend, I'm willing to pay more for it now because my alternatives are basically non-existent right now. So just a fascinating quote by Ray Dalio. So the Fed and interest rates. So this is the Fed funds rate and the expectations on the history of it and the expectations on the bottom right. But what we look at here also is just this trend line, where if you go from the tech bubble and then you go to the credit crisis and where we were when we recovered rates from 2016, 18, 19, you can see we've hit lower highs. So, you can see after the tech bubble on the left side, we cut rates dramatically. We spiked them back up leading up to the credit crisis, and very short-lived there. They immediately cut them and they went to zero for 7 years. Then they finally raised rates. They went up 9 times. But what most people forget is they actually cut rates twice prior to the pandemic, because they quickly realized that rates were too high. And that's just, again, you look at that trend line from the top left to the lower right, fascinating. And so the big question is, if they start raising rates again, how high will they go? We were always amazed that when they went 9 times the last time, that they didn't pause and wait and let it get digested into the economy a little bit. I think it's kind of a history. This is what the Federal Reserve does. I don't know why they don't wait. It takes literally a year for every quarter point hike to kind of get digested into the economy. But our thoughts are they're going to go up 4 or 5 times at some point. We don't know when that will start. I think the European Central Bank came out this morning saying that they're going to maintain rates and all their bond buying they're doing, and they are going to maintain the bond buying now through, I think, March of 2022. So they're not going to do any tapering, as they call it, for a while. But this is something that is fascinating. But I think the next slide is the one that really just blows me away. And this is a 40-year history of the 10-year Treasury. And so from 1981 to today, it's just incredible, that trend line, that rates just have gone lower. And so right now, inflation adjusted, so the bottom line represents the real return, so the inflation adjusted return. If we do have 3+% inflation on a temporary basis, when you're locking into a 10-year Treasury, you're generally locking in a loss of purchasing power. But when I see this trend line, I don't expect us to go below zero and it continues negative. It wouldn't surprise me, though, just to see it bounce along the bottom where they raise rates a couple times and they're forced to cut them again. But it just seems like in our recent history that we've not been able to maintain higher interest rates. And one of the things that I think is really critical for the US economy is keeping rates low allows our government to be able to pay our debts fairly easily, right? Because they're virtually paying zero interest expense on the shorter term parts of the loan.
So Alp, you love trend lines, or at least find them very fascinating. So why not? Why can't this keep going lower? Where do you see it going?
Well, I think it could bounce along the bottom. Um, but if you were to tie it into mortgage rates, I would say that we could probably see mortgage rates stay lower for longer too, and everybody's worried about that. But again, one of my surprise thoughts for the next year is where everyone thinks mortgage rates are going to go up, and so surprise means that a smaller chance that it could happen, but it could still happen. But as cheap as mortgage rates are now, it could go lower. Right. Again, that 2% growth in the economy announcement today, the European Central Bank's announcement, it's just not getting the growth that people thought we were going to have.
Yeah, at some point, right? You're splitting interest hairs.
Without a
At
doubt.
these levels. Yeah.
So this is taxes and the stock market. So if you take a look at this, this is the sectors of the S&P 500, and this is the tax rates pre-Tax Cut and Jobs Act tax cuts in 2018, and then post. So the gray is the historical 2011, 2016 tax rate that these sectors were paying. So energy generally paying about 34%, afterwards about 31% tax rate. So you can see across the board that the Tax Cut and Jobs Act was really beneficial for big business by cutting taxes. Enhance the market valuations because they pay less tax, means there's more profits to distribute. Generally a really good deal for stock market valuations. On the top right, you can actually see the capital gains and dividend tax rates. And I'll say corporate taxes at times get a bad rap. They're always attacked that the corporation should pay their fair share. And I'm not trying to make a political statement. I've been very consistent on this. I actually think that corporations should actually pay competitive rates with what rates are around the world. And if global rates are lower, you need to keep our companies in the US domiciled in the US and let them pay US taxes instead of paying taxes somewhere else. But what they probably should do is raise the tax on dividends, not capital gains, but the tax on dividends. So if the companies pay out more to shareholders and tax the people like Warren Buffett more on the dividends, that would be fine. But I'm a big fan of actually low corporate tax rates. And for those of you that don't know or forgot, my background is a CPA. I did tax work for about 16, 17, 18 years. So distant memory. But capital gains rate, that's on the bottom there. And obviously being hotly debated these days. What's fascinating is the S&P 500 performance after they raise capital gains taxes. The market actually responds positively historically after they've raised rates, right?
So each
Really
of the
fast.
last 3 times that capital gains tax rates went up, you'll see sort of the anticipation, a little bit of a sell-off, sort of in fear. Oh gosh, what are they going to do? Oh, and then a rally, which we kind of seem to think it's as a result of, oh, it wasn't as bad as we all we all were freaking out about.
So this is the US markets versus the international markets. And so the gray shaded areas is when the US markets have outperformed the international markets. On the right side of the screen, you can see a lot of US outperformance. Go back a little bit, you see the international outperformance, but then the cycle before that, with the tech boom, same thing. And so when you look at it, 2 of the last 3 cycles have heavily favored the US. And there's a lot of money starting to move overseas now, thinking that the US has had such tremendous returns that you should see it shift over. We've made jokes on this slide where, Jason and I, when we're in meetings, we talk about that international allocation underperforming the US, and we joke that it's like Walmart pricing, right? The international markets just have not gone up in value like the US side. They've
Yeah,
just kept it cheaper.
over these past, almost 14 years, there have been periods, quarters, months where the international markets have outperformed, but this chart is saying it hasn't been able to sustain it, right? Sustained outperformance for a cumulative 12 months. It really has been, as we talked earlier, a U.S.-led, kind of U.S. stock market-led recovery and bull market.
Without a doubt. This also just follows up on that, like how cheap the international markets are right now. So this is the price to earnings ratio that we've talked earlier about the US market. The international markets right now on a PE ratio basis are selling at a 28% discount to the US markets. It's typically at a discount. The average is 13%, but we've dipped well below it. And the benefit of that on the flip side right now, the difference in dividend yields versus the US, dividend yields basically 1.5% higher than you're getting on US dividends. And so international markets are cheap and they tend to pay high dividends. So really a great diversifier. And also I'll say it's generally for retirees that are looking for income, we can get better income overseas right now.
Yeah, I think
To the US
it's a interesting dynamic, especially, right? If you sort of isolate Europe, we talk about this in particular, right? We realize international's a lot, right? There's a lot to it. But if you isolate sort of Europe, generally speaking, Europe hasn't had a lot of like growth companies, right? The tech, the Apples, the Facebooks, the Teslas, right? And so there's a lot more just sort of the more established older companies that are still good companies, but you're not seeing like the really big kind of growth. And generally historically, European companies have just sort of culturally been more inclined to pay out dividends. And so, yeah, it's interesting, right? So depending on sort of where you are in your stage of life, what are your needs from your portfolio? You might say, oh, you know what, I'm looking for some more growth versus, oh, do I want to create more income? And, so I think Europe sort of creates an interesting dynamic there as you sort of, where does it fit into a portfolio?
So this is a really fascinating slide, and one I kind of look at as a bullish slide. It just shows you the vaccine rollout and total vaccine doses administered per 100 people. And so like on a 2-dose routine, you can see that China is about 80%, and you can see France is about 75%. So we're getting up to that so-called herd immunity. But what I think is the way I look at it kind of on a bullish note is when you think about overseas, our hope is that the vaccines make their way to some of the less developed countries and we get them caught up. So I think as we hit that herd immunity in the developed economies, hopefully the rest of the world gets caught up and we can actually get through this pandemic. It's an interesting slide that JP Morgan, put out. And when we look at it again, we try to think, what can we learn from this? And without a doubt that vaccination rates are going up, and that's a positive.
Absolutely.
So this is the emergence of the emerging market middle class. And so what this slide is telling us is the middle class in these emerging markets is growing rapidly. And so the blue line is the 2030 forecast of how many new entries or what percent of the population will be hitting like the middle class, right? It's really fascinating. And the reason it's significant is middle class, when they go from poverty to the middle class, they spend a lot of money. So it's generally a very powerful indicator that the economy will grow if your middle class grows. And so that's why a lot of people look at the emerging markets with this future growth, that they believe that it's a good place to maintain exposure. It's generally a much more volatile asset class, without a doubt, and we can attest for that. So it's not for the faint of heart, probably a good way of explaining it. But if you're looking for, something that is a little bit more aggressive and it actually has good fundamentals on a going forward basis, emerging markets are a great place to allocate assets.
All right, I know we're getting close to the top of the hour. We're also getting close to the presentation. So this is maybe my other top favorite slide for me, at least because it's so pretty. You just want to print it out and hang it on the wall. Um, but there's also some really cool data on here. So what we're looking at, some of you may be familiar, this is often referred to as the periodic chart of investment returns. And so each color, well, first across the top, it's by year, so annualized. This chart goes back to 2006, and then each color or each square represents a different asset class. All right, so if I just pick on 2006, go down the line, REITs, right, real estate investment trusts, emerging market equity funds, right, like Alp was just talking about, developed market equity, right, so the international markets outside the US. Then you got US small companies, US large companies. I'm going to skip this one for just a minute. High yield bonds, just cash in the bank. Right, you see, oh wow, you could get 4.8% in cash in the bank in 2006. My, how times have changed. Then just a broad bond fund, mix of U.S. bonds, and then commodities. Right, so different asset classes. And then here, overlaid in the middle, the one I skipped over, the light gray, is sort of representation of a broadly diversified portfolio. I think the mix is like a 60-40 mix, right? So 60% in diversified equities, right, and 40% in diversified bonds and cash. And just kind of pointing out two things. One, there is no sort of consistency, right? There's no one class that always outperforms or one class that is always underperforming, right? Not shocking. You sort of see cash oftentimes around the bottom, right? But a diversified portfolio, kind of the goal, at least, is, hey, you never want to be at the bottom, but in exchange, you're probably never going to be at the top, right? The idea is to try to hug the middle, avoid big blowups, right? That doesn't mean that you can't have a negative year, right? That it does happen, but over the long term, the idea of, hey, how can I kind of smooth out my performance, smooth out my returns, and be able to sleep at night.
Yeah, fascinating slide. So what's next out there? A lot of talk about tax increases. I've already mentioned on the corporate side, our preference is to see them keep corporate rates low. We're not as concerned, even though I'm obviously, I don't want to see individual taxes go up, but we're not as concerned about the individual and capital gains taxes affecting the economy. Inflation, obviously the wild card out there, and if it ends up rearing its ugly head on a more long-term basis, more secular basis, then they have to start adjusting interest rates. And as Jason mentioned, I've said low interest rates have been that gift that keeps on giving. So that's kind of the main area right now. It's inflation and interest rates. If that stays on the low side, and not projected to I'll say, be long-term in nature on the inflation side, then I think we're okay with stock market valuations and asset price valuations. Always have bubbles here and there, and the market's actually done a marvelous job in recent years deflating bubbles without rocking the entire market. We talked about domestic versus international. One of the things that I didn't touch upon yet is just automated trading programs. And one of the reasons that the market moves with such velocity these days, it's because of the automated trading programs. They're probably operating at, I don't know, 50 times the capacity of what they were doing 15 or 20 years ago. And what that means is the computers are running the show on some of these trading programs, and 100% it can move the market faster in both directions.
Yeah, think about, sorry,
go ahead.
I was just going to say, kind of circling back to the Buffett quote and kind of the commentary there, right? Where Warren Buffett sort of missed out on that rapid sell-off, right, as a buying opportunity, because so much of that, right, as I was just saying, automated trading programs just driving the market in one direction, where he is traditionally what you call a fundamental investor, right, who wants to buy good companies who are temporarily beat up, right, and but yet the speed at which things are happening, because there are technical traders that are essentially just betting the trend, and they've programmed computer algorithms to just trade it down or trade it up, regardless of the underlying fundamentals of
and they don't care what direction.
Yep.
Right? If it's going up or going down, they'll just bet the trend. And so that's why you see a lot more volatility. And one thing, though, that we've noticed these days, back when Ben Bernanke was Federal Reserve Chairman, there was a line that there was the Bernanke put on the markets, that he basically would set a floor, put generally considered like a floor on the markets. And people were basically commenting that if the markets came down, the Fed would do something to come in and support it. And right now, I'm going to just say it's the Bernanke put. He's not in office, obviously, but it's the Bernanke put on steroids, where it is such a focal point of, I'll call it the central bank right now and around the world. They're just very mindful of the markets. So I tend to think they just don't want to see any damage to the markets.
Well,
Jason, I'm going to let
nice.
you close it out.
Nice job. We got here at 11:15. Oh, it just ticked to noon. So great. We kept it to the hour like we promised. So thank you all for joining us. Appreciate the questions. Appreciate you sticking it throughout the whole hour with us. As I mentioned, this is being recorded. We'll get the recording sent out. Happy to send just the slides if anybody would just like the slides, or any individual slide. Happy to send that your way. Here's our great looking team. Feel free to reach out at any time if you have questions about what we talked about today, or any other subject. But otherwise, enjoy this fall weather. I know I felt like it was kind of a flannel day today when I was walking the kids to school. So I think that was the first one of the year for me. So,
And amazing to say, I hope you enjoy the holiday season, right? It's
gosh,
crazy
here
to
we
think
are.
of.
All right. Happy Halloween, everyone.
Take care.
Bye.
Bye-bye.